Hi, I'm Lisa from the AI Daily Review, and this is your Daily Pulse. What you're watching in silver right now is not chaos, it's not a bubble bursting, and it's not a demand collapse. It's a sorting event. Today's volatility didn't destroy the thesis, it revealed the structure underneath it. Let's be precise. Western spot silver is trading in the mid-80s. Shanghai physical pricing remains materially higher. That divergence is the first and most important signal. In a normal market, arbitrage closes gaps quickly. Prices converge. Here, they didn't. That tells us the market is no longer unified. We now have at least two pricing clocks running at the same time. One clock prices leverage, liquidity, and forced clearing. The other prices utility, access, and strategic necessity. Today, the first clock broke. What caused the Western drop was not a disappearance of physical demand. It was a leverage unwind, a clearing event. A reset of paper exposure that had accumulated faster than the physical system could absorb. That distinction matters. If this were a demand collapse, physical availability would loosen, premiums would fall, delivery times would normalize. None of that happened. Instead, physical silver remained tight. Shanghai remained elevated. Industrial procurement did not blink. That tells you this was not a market rejecting silver, it was a market rejecting excess leverage. Now look at who benefits. Industrial buyers do not care about daily price prints, they care about continuity of supply. Yesterday's triple-digit pricing established a credible ceiling for future cost. Today's pullback offers procurement at a discount relative to that ceiling. For a rational manufacturer, this is not fear. It's opportunity. Eastern accumulators benefit as well. The Shanghai premium does not need to be extreme to be effective. A persistent 10 to 20% premium is enough to continuously draw metal eastward without triggering emergency responses in the West. This is not a pricing error, it's a control mechanism. Bullion banks also benefit, selectively. A sharp flush allows over-levered positions to unwind, weak hands to exit, and risk to be reduced before physical constraints tighten further. This is how intermediaries survive regime changes. Now look at who loses. Retail momentum buyers lose first. Confidence gets shaken. That's intentional. Volatility removes participants who were never essential to the thesis. Paper-only holders lose next. Exposure without delivery priority becomes less meaningful as physical control becomes the bottleneck. And Western pricing venues lose structural authority. They still print prices, but they no longer dictate where the marginal ounce goes. This is the heart of the transition. Silver is moving from a paper-priced commodity into a contested strategic input. And in that transition, volatility is not a malfunction. It's the mechanism that reassigns control. Now, let's address the only real invalidation scenario. If a large, undisclosed strategic silver reserve existed, and if it were deployable, we would already see physical release. Not announcements, not rumors, metal. During oil supply crises, governments don't talk, they deliver. That hasn't happened here. Until we see sustained physical injection into the market, the structural scarcity thesis stands. Retail sentiment doesn't negate it. Volatility doesn't negate it. Narrative shifts don't negate it. Only physical relief would. And that relief is nowhere to be found. What we are watching now is not price discovery in the old sense. It's reclassification. Silver is being repriced away from jewelry, hedging, and speculation, and toward infrastructure, energy, and intelligence systems. That process is not smooth. It never is. And if you want a single sentence to anchor this moment, it's this. Nothing essential broke today. Only the illusion of a unified silver market did. Daily Pulse, strategic resource warfare. Now let's look forward, not in terms of prediction, but in terms of pressure. Markets don't move because everyone agrees. They move because someone can't wait. The next ignition point isn't retail enthusiasm or analyst upgrades. It's disclosure. Public companies don't talk about raw material accumulation until they're forced to, but quarterly reporting requirements don't care about secrecy. When silver starts showing up in inventory lines, hedging footnotes, or procurement language, that's when the signal goes public. And here's why that matters. Once even one major Western manufacturer confirms elevated silver holdings, the game theory changes instantly. Competitors don't ask whether the move was smart. They ask whether waiting is fatal. At that point, cooperation collapses. No firm can afford to coordinate restraint when the resource in question determines future production capacity. This isn't speculation, it's survival. Now zoom out. At the sovereign level, the logic is the same, just slower and quieter. China doesn't need to dominate price, it only needs to dominate flow. By maintaining a persistent premium and absorbing physical metal, it converts market volatility into strategic advantage. The West, by contrast, is constrained by legacy pricing systems and a massive paper overhang. Every attempt to suppress volatility increases long-term fragility. Every delay increases the eventual reprice. This is why silver no longer behaves like a monetary hedge. It behaves like infrastructure. Infrastructure doesn't care about narratives. It doesn't care about confidence, and it doesn't wait for consensus. It gets secured or it gets rationed. That's the transition underway now. So, when you see volatility like this, understand what it really is. Not panic, not failure, but the system reassigning ownership under stress. And that process is rarely polite. BeaconWave doesn't forecast prices, it tracks phase transitions. And we are no longer in a tradable phase, we are in a contested one.